Welcome to Season 2 of the Learn and Trade Forex podcast, where your financial journey transforms into a trading adventure with your host, Gary Phillips, author of Trade Your Personality, bringing you the ins and outs of the Forex market. Here we dive deep into the currents of currency trading, from basic concepts for our newcomers to advanced strategies for the seasoned traders. Drawing from Gary's book, we'll explore how aligning trade strategies with your personality can significantly enhance your trading experience. Each episode is packed with Forex insights and real-world trading scenarios to guide you through the complexities of the Forex market. And if you're looking to take your trading to the next level, visit us at www.learnandtradeforex.com for one-on-one sessions. So buckle up and let's embark on this journey together. Let's decode the markets, unlock your trading potential, and discover how your unique personality can be your greatest asset in Forex trading. Welcome aboard with Learn and Trade Forex.
Welcome to Learn and Trade Forex, your go-to podcast for insights and strategies in the world of Forex trading. Today, we have an exciting and informative episode lined up for you. We'll be diving deep into the world of central bank policies and how they shape the Forex markets. From recent central bank decisions to effective trading strategies, this episode will equip you with the knowledge you need to navigate these complex waters. So let's get started. Central banks around the world play a crucial role in influencing currency values through their monetary policies. Let's start by analyzing some of the recent decisions made by major central banks like the Federal Reserve, the European Central Bank, and the Bank of Japan. The Federal Reserve recently raised interest rates in an effort to combat rising inflation. This decision has strengthened the US dollar against other major currencies, making it a critical factor for Forex traders to consider. Similarly, the European Central Bank has been cautious with its rate hikes, balancing economic growth and inflation concerns. Meanwhile, the Bank of Japan has maintained its ultra-loose monetary policy, keeping interest rates negative to stimulate economic activity. These decisions have had significant impacts on currency pairs. For example, the USD-JPY pair has seen increased volatility as traders react to the contrasting policies of the Fed and the BOJ. Understanding these decisions helps traders anticipate market movements and adjust their strategies accordingly. Central banks rely heavily on economic indicators when making policy decisions. Key indicators such as inflation rates, employment data, and GDP growth are crucial. For instance, the Federal Reserve closely monitors the US inflation rate, aiming for a target of 2%. When inflation rises above this target, the Fed may increase interest rates to cool down the economy. Traders should pay attention to these indicators to predict central bank actions. For example, a higher-than-expected employment report can signal economic strength, prompting a central bank to raise interest rates, which would likely boost the currency. Staying informed about these indicators and understanding their implications can provide traders with a competitive edge in the market. Geopolitical events and trade policies also have a significant impact on Forex markets. Recent geopolitical tensions, such as the trade disputes between the US and China, have led to fluctuations in currency values. For instance, during periods of heightened trade tensions, safe haven currencies like the Japanese yen and Swiss franc tend to appreciate as investors seek stability. Short-term effects of geopolitical events can be seen in rapid currency movements, while long-term effects may influence central bank policies and economic stability. Traders need to stay updated on geopolitical developments and consider their potential impacts on the Forex market. Now, let's discuss different monetary policy strategies and their implications for Forex traders. Central banks employ various strategies, such as quantitative easing, which involves purchasing government securities to increase the money supply and stimulate the economy. Conversely, tightening policies like raising interest rates aim to control inflation and slow down economic growth. Historical examples provide valuable lessons. The quantitative easing policies adopted by the Federal Reserve during the 2008 financial crisis helped stabilize the economy, but also led to a weaker dollar. Understanding these strategies helps traders anticipate market reactions and develop effective trading plans. Effective trading strategies are crucial during periods of central bank activity. One approach is to trade the news by monitoring central bank announcements and economic data releases. Traders can capitalize on the volatility by entering positions before or after significant announcements. Risk management is equally important. Utilizing stop-loss orders and managing leverage can protect traders from excessive losses during volatile periods. By combining technical analysis with a deep understanding of central bank policies, traders can navigate the market more confidently. Let's dive into some case studies to see how specific central bank decisions have affected currency pairs. One notable example is the Swiss National Bank's decision in 2015 to remove the Swiss franc's peg to the euro. This move caused a massive appreciation of the franc and led to significant market disruptions. The abrupt decision by the SNB caught many traders and financial institutions off guard, resulting in substantial losses for those who were unprepared. The sudden surge in the franc's value disrupted exports and impacted the Swiss economy, highlighting the far-reaching consequences of central bank policies on currency markets and national economies. Another significant case is the European Central Bank's introduction of quantitative easing, QE, in 2015. This policy involved purchasing large amounts of government bonds and other financial assets to inject liquidity into the economy. The aim was to combat deflation and stimulate economic growth in the Eurozone. As a result, the euro weakened significantly against major currencies like the US dollar, making European exports more competitive, but also raising concerns about inflation in the long term. This case illustrates how unconventional monetary policies can have both immediate and prolonged effects on currency values and economic stability. The Bank of Japan's continued commitment to ultra-loose monetary policy, including negative interest rates, provides another instructive example. By maintaining these policies, the BOJ has aimed to combat deflation and stimulate economic activity. However, the persistent weakness of the yen has had mixed results. While a weaker yen has benefited Japanese exporters, it has also increased the cost of imports, impacting consumers and businesses reliant on foreign goods. The yen's volatility in response to these policies underscores the complex interplay between domestic economic goals and international market reactions. Lastly, consider the Federal Reserve's gradual increase of interest rates starting in 2015 after years of near-zero rates following the 2008 financial crisis. This policy shift was aimed at normalizing monetary conditions as the US economy recovered. The gradual rate hikes led to a stronger US dollar as higher interest rates attracted foreign investment. This case highlights how even anticipated changes in monetary policy can drive significant shifts in currency values, affecting global trade and investment flows. By examining these case studies, traders can learn valuable lessons about the impact of central bank decisions on currency pairs. Understanding the rationale behind these decisions and their market consequences can help traders develop more informed and resilient trading strategies. That wraps up today's episode of Learn and Trade Forex. We hope you found our discussion on central bank policies and their impact on Forex markets insightful and useful. Remember, staying informed and adaptable is key to successful trading. Don't forget to subscribe to our podcast for more expert insights and trading strategies. Until next time, happy trading. Thank you for joining us on this journey through the complexities of central bank policies and Forex markets. If you have any questions or topics you'd like us to cover in future episodes, feel free to reach out. Stay tuned, stay informed, and keep trading smartly. Goodbye.
And that wraps up another episode of the Learn and Trade Forex podcast with your host, Gary Phillips. We hope today's insights illuminate your path in the Forex trading world and inspire you to explore new strategies with confidence. Remember, trading is a journey, and we're here to guide you every step of the way. For personalized guidance, don't forget to book your one-on-one sessions at www.learnandtradeforex.com. Stay tuned for more episodes, and until next time, keep analyzing, keep trading, and keep growing. Thank you for joining us at Learn and Trade Forex.